amazing. In the last 5 years, the stock market, specifically like the S&P 500, has been up approximately 180%. And this is under a climate where unemployment has been very high until recently. We've had basically modest to tepid economic growth. So the big question I get asked a lot is, why are stock prices going up so much? And when in terms of answering it, it really comes down to one main factor, and that is it's what the central banks around the world, specifically the United States Federal Reserve Bank, has been doing with respect to keeping rates, interest rates, ultra low. Since the financial crisis in 1998, when it looked like the entire economic system, global economic system, was going to fall off a cliff, central banks around the world, led by the Federal Reserve, have been engaging in multiple policies to stimulate economic growth. And one way they've been trying to do that is to lower interest rates, and they have done so. Interest rates over the last 5 years have been next to near 0%. Second way they try to stimulate growth is to print more money and inject more money and liquidity into the financial system by printing money and using it to buy government debt or mortgage-backed securities. And by doing that, by buying those type of securities, it's increasing the price of those securities, but it's at the same time keeping interest rates low. So what do low interest rates do? Well, they do a couple of things. Well, first of all, by lowering interest rates, the cost of borrowing money is low. So if the cost of borrowing money is low, then the interest rates, the interest payments that a company will make on that debt will be lower, which will technically, theoretically, improve their profitability. If you improve their profitability, that will be a factor in driving your stock price up. Second element too is by lowering interest rates is that your cost of capital, a company's cost of capital, will go down. And when you go to value a company's stock using a discounted cash flow approach, a lower cost of capital will increase the valuation of the company. So when we're looking at what's been going on in the last 5 years, the bull market in stocks has really been driven by the low interest rate policy by the central banks around the world. And it's created some, I don't know, unintended consequences or unintended behavior by companies with respect to how they manage their business and also how they try to create wealth for their shareholders. Well, what's been happening is, as a different kind of behavior, companies seem to be more engaged in taking that money and using it for more financial engineering purposes with respect to, for example, buying back more stock or issuing more dividends. Now, the impact of doing that kind of financial engineering, for example, buying stocks, the company would be reducing the amount of shares outstanding, which would increase their earnings per share and their profitability, which would again be a factor in driving the share price up. With respect to paying more dividends or increasing dividends, that also has a factor because a lot of investors out there are looking for returns or a steady stream of income and returns. And if a company is paying more dividends, it makes their stock more attractive and people will want to buy that stock a little bit more. So if you take the combination of low interest rates with some financial engineering by the companies, you're kind of creating an environment for stocks to trade at a premium. The other element of having low interest rates is that as investors, if you're getting only 0.5% in your bank, that's not going to really do anything for your portfolio or do anything for you to meet your long-term goals. You're going to be looking for yield and returns, higher returns elsewhere. And what's been happening is lower interest rates have forced investors to take on more risk or look for more riskier assets to get higher returns. And one of the more riskier assets you can buy out there are stocks. Now, I've got nothing against financial engineering. It's a totally legitimate way for companies to increase wealth and increase value in their stock. Now, buying back stock, if the company thinks that their stock is undervalued or underappreciated by the market, buying back more of that stock or returning the excess capital back to shareholders is a totally legitimate way of doing it. Paying more dividends is absolutely a legitimate way of creating wealth, creating value, because if the company has excess cash in the reserves and it feels it may be better suited to returning that capital back to shareholders. Those are totally legitimate ways for companies to create wealth. Now, my issue really is it shouldn't be their core or main way that companies should be creating value. Ultimately, companies are in businesses to create products and services that people will want, and ultimately that type of organic growth or organic investment should be made by companies. And what seems to be happening is that's not happening. It's more about buying back stock. It's more about financial engineering. And a classic example of that is IBM, a company that's really had increasing, if you look at their financial statements, their profits have been going up and up and up over the last 3 years. But if you look at dig down deeply, the revenues have been essentially flat or falling. The demand for their products and services around the world has been falling, yet their stock price is pretty high and their profits are pretty high. So what have they been doing? They've been essentially engaging in a very aggressive program of simply buying back stock and increasing dividends, and that has helped them essentially goose up their profits and have kept their share price at a very high level. So financial engineering is very useful, but it should not be your sole strategy. It shouldn't be a company's sole strategy for creating value for its shareholders. So that's kind of the main reason why stock prices have gone up so far in the last 5 years, and that's the way it's been. The question now, I guess, for investors is, what does the future hold? Will stock prices continue to go up at the same rate that they've been going up in the past? As an investor, should I be putting more money into stocks and riding the wave? And the answer really comes down to what's been going on in the market. And essentially the stock market is, thanks to the central banks around the world and the low interest rate policies, it's become a game of musical chairs. And as long as central banks keep interest rates low and continue to issue print more money to buy back more government debt and put more liquidity into the markets, into the economy, the environment is there for stocks to continue to go up. The question is when is the music going to stop? And the fact of the matter is interest rates at 0% cannot stay at 0% forever. At some point they're going to move up, and historically interest rates are more like 2, 3, 4, 5% range. So when interest rates go up, it's going to have a meaningful impact on companies' profitability. It's going to have a meaningful impact on a company's cost of capital in terms of valuing the company. It's going to have an impact in terms of consumers wanting to borrow to make big purchases, like for example houses, cars, those kind of things. So that at some point, when interest rates do start to go up, and when central banks start stopping to print money or easing their ability to print money, which is happening, that should be a signal for stocks to kind of reverse the trend and trend downward. The question is, when is that going to happen? Nobody really knows. Some people think it's going to start happening in 2015. Some analysts think it's going to happen later this year. It really depends on some of the economic variables that are in place. But at some point, it's going to be important as investors to be aware of these elements and factor those in terms of your decision making of how you want to position your portfolio going forward.